Well, thank you very much. I'm very honored to be here. I remember 15 years ago, Sebastian and me were sitting in the Hotel Steglitz as grad students thinking, will we ever come up here? I was so excited when I arrived at the airport that I went all the way to Steglitz to find out that there's no hotel and that you didn't tell me that you changed the hotel venue. But I'm really honored to be here. Today, I'm going to talk about work that I've been done in the last 2 years. I joined the World Bank 3 years ago, and this is also joint work with Remzi Baris-Terzioglu, who's not here today. I think he's in the live stream. I hope so. I feel a little naked because he's the Turkish expert, and I know that the audience is full with Turkish expertise, so have mercy on Turkey. I'm more confident about the modeling of it. 2 disclaimers. First, I'm not a senior economist, I'm just an economist, but ready for a promotion. And second disclaimer is that this is my personal views, right? This is not the views of the World Bank, not necessarily. I want to give an overview of the model that we've been working on, then show some climate policy simulations for Turkey, and then some concluding reflections on the intersection of like what it could mean for post-Keynesian economics in particular. So on the model itself, what is the academic puzzle that we are trying to solve with this work? Well, there's not really an academic puzzle. That's the perks of working for an international organization. We have to convince policymakers and not referees that are born to reject your paper and always want you to focus only on the very necessary things to get a point across. So we are able to now to build sufficiently or sufficiently big models to cater to the needs of policymakers. And so what is the background of this work? As you know, the Paris Agreement requires the countries, the parties to publish their NDCs, which are basically emission commitments, or not necessarily commitments, but announced plans, more or less. And the question is, what are the policy mixes that get the job done? That's what they are mainly interested in. And they come up, when we engage with governments, they usually have a very wide range of policy ideas that they think may affect the emission trajectories. For instance, we can probably categorize that into incentives, public investment, and regulation. So that includes the taxes and subsidies, of course, the ETS, like the emission trading systems, but then also a lot of green finance, like little either green bonds that are just labeled green or that have some incentive structures, like where the payout depends on like your key performance indicators. So there's a lot of like subtle incentives where policymakers think that they make a difference. Then, of course, public investment in different sectors, in distribution and storage of electricity, in generation, public transportation, and so on. And, of course, there's a lot of regulation that is on the table. And something that I think is important for the debate is the question of policy credibility, and I see that there's more and more research also in the heterodox field on how policy credibility interacts with the cost of the transition, or I should say the net cost or the net benefits of the transition. This is the model that I've been working on, particularly on the last couple of years. It's an open economy, multi-sector, endogenous growth assessment model. So we called it Omega because everything important has to have a label, a name. So this is what it is, Omega. I should also say that this is a model which builds on earlier work that I've done on a 2-year grant that was funded by the Hans-Böckler Foundation. So any damage that's done by this model is the Hans-Böckler Foundation's responsibility. So this builds on this disequilibrium work that I've done that has also been reviewed by Eckhart, I think, and Engelbert, like many years ago. So this is an integrated framework because it tries to capture many different policy domains, including climate, fiscal, and monetary policy. And it does have orthodox micro-foundations. And I will show you some slides on the model equation, or like at least one. But, and I'm very emotional about that, it's not DSGE, because it's not general equilibrium. And I have 2 slides where I want to get this point across. It has orthodox micro-foundations, but it has very Keynesian implications in terms of like Keynesian results. There's endogenous growth through human capital accumulation and learning by doing. So there's hysteresis built into the model, which I think some neo-Kaleckians will like, because it has the implication that a permanent level shock has a permanent growth rate effect. Not just level, but level growth. The model is fit with calibration and estimation techniques, which are very standard in the DSGE literature. So I will also show some results, and I think this is also something that, in terms of the empirical evaluation of a model, the post-Keynesian SFC modeling traditions can actually learn something from, or at least consider it. A small variant of omega of the model is published in a recent World Bank working paper. So if you want to see the details of what we're doing, because I won't be able to cover actually a lot. Let me maybe show this slide first. So I'm happy to discuss it now after the presentation or over dinner, but I find it useful to, when we assess models or try to categorize models, that we distinguish at least between 2 dimensions. One is, what is the model closure? That's related to the market. Like how do we think that prices adjust and quantities adjust? So this is what we all know from, let's see, for instance, Stephen Marklin's 1987 book, Growth, Distribution, and Prices. So this introduces this concept of closures, or makes it popular, and distinguishes between different market closures. And the other dimension, which is orthogonal to it, so it's independent from the market closure, is how you motivate your behavioral assumptions. Like, how do you come up with your behavioral model equations? The post-Keynesian tradition is more the behavioral heuristics, and the opposite is intertemporal optimization. So omega is located more at the intertemporal optimization part, but it's very broad in terms of the market closure, because, and as I will show in a second, whether the model is more towards, or the pure post-Keynesian core of effective demand, or more on the neoclassical side, depends on a certain parameter, which is how strongly the nominal wages respond to the labor market disequilibrium. Now, after like having a conversation with a few of you that work also on experimenting with different expectations in SFC models, I feel that there should be a 3rd dimension, and this behavioral heuristics and intertemporal optimization should be broken up into the actual, well, how to come up with the model, the behavioral equations, but then the other dimension would be, what is the assumptions regarding expectations? In all models, there's expectations, right? In an SFC model, there's expectation about future utilization rates that determine investment. But what's usually done is that these expected values are some function of what happened in the past. But now I see that some people are also experimenting with some type of forward-lookingness. And I think this is especially, this is my point in the end, I think for the climate debate, where investment decisions are very long run, finding a way to incorporate this type of forward-lookingness in expectation, doesn't have to be rational expectation, but some forward-looking element, I think, will be a fruitful addition to the discussion. So why do I say this model is disequilibrium and Keynesian and not neoclassical like DSGE? And it all depends on this one parameter, which is the labor market elasticity of wage inflation. So how strong does the nominal wage respond to unemployment in the Phillips curve relationship? So if this is a very rapid adjustment, then we are in the perfect neoclassical case where there's immediate price adjustment to clear the labor market. But if this is 0, then we have a non-responsive wage, and we are in the pure, simple Kaleckian case where basically the market is constant. So we get the principle of effective demand, meaning that demand shocks drive output, whereas in the neoclassical case, there's the factor market determines the output. So the factor market's clear, and then you have the output, they have the resource constraint, and then this gives you kind of consumption. The principle of effective demand means that demand is determined by output. The other implication that, I mean, you all know that productivity shocks in the demand level means you just need less resources, right? If there's a productivity shock in a Kaleckian, post-Keynesian model, what you'll find is that there is less labor input and higher unemployment. In the neoclassical models, you have an output boost. So the factor market's clear, you're more productive, and then you have a higher output. Interestingly, so there's post-Keynesian and neoclassical, they have very different implications in many fields. And one is, for instance, the Taylor principle. Right? In DSG models, you need the Taylor principle, meaning that you need an aggressive central bank that responds to inflation in order for stability and to rule out kind of self-fulfilling prophecies and what we call sunspot equilibria. In our model, in omega, we don't need that necessarily. Yeah? So if this labor market response parameter is low, the Taylor principle is not required. We can have a very low response to inflation, which creates other issues, but in principle, that's not required. And also important, in our model, the interest rate at the steady state in the long run is smaller than the growth rate. This is what the stock flow people always criticize with the DSG world, right? Because in their world, you need this, what they call dynamic efficiency, right? Which requires that the interest rate is higher than the growth rate. And that only works because they don't have wealth in the steady state. Saving is purely transitional, so this doesn't create exploding debt dynamics. Okay. So I just want to show you like this slide on the model itself before I show you some simulation results. This is what the firm does in the value-added sector. It has many control variables. It chooses the output price, and I'm going to talk more about the pricing and the investment or the finance decision. So it chooses the price. It chooses all type of inputs from other sectors, from the households, like high-skilled and low-skilled labor. It invests. It chooses the utilization of the capital stock. Because it's a climate model, there's also some abatement, so it can reduce its emissions for a given fuel input, which is the abatement effort. That is costly, of course. Then it holds liquidity, which I find is a nice feature, which I will explain in a second. It holds liquidity. And it borrows from domestic and abroad. So how does the price setting and wage setting work? And now this is also something we can discuss over dinner. It operates under monopolistic competition, and it sets the price over marginal cost. Right? And I would argue that this is some type of interpretation of Kalecki's degree of monopoly, because if you assume a Leontief production function, then you will get the standard Kaleckian result of a stable cost push inflation, like the neo-Kaleckian interpretation of this. So you have a pure cost push inflation because the marginal costs don't change as you increase output. What we assume in the model is a constant elasticity of substitution production function, which nests Cobb-Douglas and which nests the Leontief production function, which is usually assumed in post-Keynesian models. So, but I should also say that this is not supported by the data because we estimate this elasticity parameter. And the data does not say that it's 0. It says it's, I'll show you the results. Important for the question of inflation is how, and that also goes back to Eckart's presentation, how flexible is the production structure? The more rigid the production structure is, the more cost-push shocks, like let's say a carbon tax or like a higher energy price, will propagate through the system and cause overall inflation, because there's not much adjustment that firms can do. The other part is the wage setting. And I probably don't have to convince you, because post-Keynesian usually assume some administered wage cost, right? The wage is not an equilibrating variable like the price in the goods market. Oh, sorry, that's also not equilibrating. But the point is that the wage in post-Keynesian model is an administrated variable, or like a policy variable. And of course, I always get the response from the mainstream side, from the DSG world, this is ad hoc. Why do you assume a Phillips curve? This is ad hoc. And then my response to that is, well, you do the same with the monetary policy rule. You assume a policy rule for the interest rate, right, which is a super endogenous market variable. So if it is okay to assume a policy rule for a interest rate, it's okay to assume it for the low-skilled segment of the labor market as we do. And in Turkey, for instance, 50%, and the Turkish colleagues know that much better than me, 50% of the Turkish wage earners receive a minimum wage. Then on investment, so I think, again, there's some similarities to the, or some interpretation which are consistent maybe with a post-Keynesian story. So one implication of the model setup is that the shareholder value is implemented. It's also an implication because households have a preference. Households own the firms and they have a preference to extract all the cash flow from the firm. So they want them to exploit all the available credit lines. So the bank, they will impose a borrowing constraint to set the limit because they don't want to give infinite cash flow to the firms. And so this is the equation. The implication is that this borrowing constraint is endogenous to the value of the collateral, which I think is also not surprising. But I think the interesting part is that this is consistent with a horizontalist view of money supply, or of endogenous money, because it means that up to the credit line, the banks can just create money, and there's no financial, you don't need to create more money to have more liquidity. The Modigliani-Miller theorem is violated, so the structure of the firm matters. And what I mentioned before, firms have to have liquidity. And this is like an interpretation of Kalecki's principle of increasing risk. What does this say? It says, well, firms don't have easily access to external funds, so they have to have some cash flow, they have to hold some liquidity to actually have access to that external funds. And this is exactly what we introduce here. Firms need to have liquidity in order to reduce the finance premium on external funds. So the more they hold on liquidity, the lower they have to pay on a markup. So for instance, in Brazil, it's around 7%. What firms have to pay in addition on the investment goods just because of this external finance premium. Okay. Let me show you some results for Turkey. As I said, this model is estimated using Bayesian methods, and I showed just a selection of this elasticity of substitutions, which govern the rigidity of the system. And I didn't show you the whole production structure, but there's like renewable energy, fossil energy, energy, capital, and labor. And for instance, the first graph is the elasticity of substitution between value added, which is capital and labor composite, and energy, which is itself a composite of renewable and fossil energy. And this is estimated to be around 0.8. We started with a prior of 0.5, and then the data says, nah, it's higher, it's around 0.8. And you see that this is not a point estimate, it's just a distribution. And the uncertainty of that is carried through all the results. So later on, when I show the simulations, this parameter uncertainty will be reflected. It doesn't get lost by just fixing the parameter. There's households that consume energy, and then there's firms that consume energy. And the households substitution of energy goods and non-energy goods is very rigid. So that's very complementary, meaning that if, let's say, they want to consume more core goods, they also will have to consume more energy. So that's not, households cannot easily substitute away from energy, or like, yeah, energy. Then, for the elasticity of substitution between value added and carbon, so carbon enters the system in the fossil fuel sector, and of course, if you produce fossil fuel, you cannot just say, okay, I produce the same fossil fuel, but I just reduce my carbon input. Right? So that's very linked to oil. There's a little bit of flexibility because the energy mix, the fossil energy mix can change. You can replace oil by gas, but overall there's not much substitution. Interesting is the bottom left chart, which shows the elasticity of substitution between renewable energy and fossil energy for Turkey, and that's estimated to be around 17, with quite some uncertainty. The the substitution between high-skilled and low-skilled labor is around 3, so it's also higher than we anticipated, so the priors are usually started from the literature, from the related literature on other countries also. And the last one is probably the most important one. That is the employment elasticity of the low-skilled wage inflation. So that's this Phillips curve parameter. If that was 0 in Turkey, that would mean we are in a pure Kaleckian case where the nominal wage does not respond to the labor market situation. But it's not perfectly identified, but it seems that the data prefers a little bit a value around 1. So that actually, that makes the model quite similar to a DSGE overall. But there's an easy explanation for that. Turkey, so the sample is the last 20 years, and Turkey grew very rapidly in the last 20 years. So it's not implausible to assume that Turkey operated a lot at capacity. So we also did this exercise for Brazil, and here the response parameter is much, much lower. Yeah? Brazil grew around 1% in the last 20 years, more or less. Yeah? Turkey around, I don't know, 3–4%. Okay, so now, based on this parameter, some simulation results. So we look at here the carbon tax, renewable energy subsidy, public investment in renewable generation, so not infrastructure, so purely produce more renewable energy like solar energy or wind energy, public investment in renewable infrastructure like the grid. And here we distinguish 2 cases. We say that there is a saturation point of infrastructure. At some point you have enough grid, right? And we use some external data to kind of quantify that. We have a lot of expertise in the World Bank on energy markets, so we got some numbers on like what is the grid capacity and storage capacity, what are the investments needed. And we assume that when you're below this saturation point, the additional investment incentivizes private investment, because you have access to the grid and that unlocks opportunity. But if you are at it, then there's no more additional incentive. You can invest more in infrastructure, but it will not create more incentive. And as you can see, and that's also very consistent with Eckart's point, if you invest in infrastructure, that will take off a lot of pressure from inflation. The strongest negative effect on energy price inflation is actually coming from public investment. So one side result is that also monetary policy is very important for determining the overall effect of, let's say, a carbon tax on GDP. Like how bad is a carbon tax for GDP? And that depends on how strongly the central bank steps in fighting the inflationary effects of a carbon tax. So here we're looking at 2 cases. We say this, in the red line is like what we estimate, which is a moderate response, probably even still too optimistic given the recent Turkish experience. But the counterfactual scenario is, well, actually that's mixed up. So, yeah, no, that's right. So the blue line is when is a lenient central bank that does not step in a lot, and that creates actually an expansion of GDP. And the reason is because the tax is inflationary, it reduces the real interest rate, and the lower real interest rate has expansionary effects on consumption, on investment. So I'm curious to see how maybe in other SFC models a simulation like that would look like, because I feel like we don't have a good theory of what are the contractionary channels of, let's say, low real interest rates in an emerging market context. Okay, so another exercise that we did, and this is actually the core exercise we're trying to do in the last 5 minutes, we try to forecast the policy mix that gets the job done. So we ask the policymakers, what are the objectives? What do we need to achieve? They would say, well, we want to have net zero until 2050. That's what we assume here. We want emissions to go down gradually until 2050 to net zero. but you also want to make sure that the low-income households are not worse off. So we implement an additional constraint, which is the household consumption of the low-income household consumption cannot go below the no policy baseline. So we have transfers that endogenously adjust such that they are not worse off. And then there's a few more. For instance, the fossil fuel subsidies phase out. And another important one because it's the World Bank, public debt cannot explode. So we have to keep the level of public debt stable. And the particular scenario that we consider here is the following. We phase in a carbon tax. So we phase out the fossil fuel subsidies. We phase in the carbon tax until the public budget is consolidated to a certain debt to GDP ratio. And once this is reached, we phase in a subsidy, a renewable subsidy. This is the yellow line that you see. So this incentivizes a boom in renewable energy. You can even reduce the carbon tax again, because you create a lot of fiscal space with this carbon tax. But as the tax base erodes, there's less and less emissions, less and less fuel inputs, tax base erodes, and you have to phase out the renewable subsidies again. And at that point, to keep the budget stable, we assume that the government spending has to decrease slightly. And this is the conditional forecast that we get. So this is what the model tells us, given all these constraints. This is the policy mix that gets this job done. This would be the forecast for the renewable energy and the fossil energy. So renewables increase, fossils phase out. So let me be brief here. And the GDP effects are very moderate, not very exciting. I want to raise another point. I mentioned before the role of expectations. So my argument is this. In the low-carbon transition, right, we want the private sector invest. We want to motivate the private sector to invest in clean energy, in low-carbon technology. And most of the capital stock is just very long-living. So if you assume a depreciation rate of 2%, let's say, or 3%, then you have an expected lifetime of 40 years. So, of course, expectations matter a lot. Maybe not so much the overall investment, right? I don't necessarily question relating investment to the utilization rate. But when it comes to the choice of technique, be it clean or dirty capital, here it matters what the expected benefits are. And what we did in these exercises, we looked at 3 different regimes of what people would expect, what happens to policy. So all of them have in common that they have to achieve this emission target. And there's the first scenario, which is the policy is perfectly credible. So the government says, this is what we're going to do, and this is what will happen, and everyone believes it and acts upon it. The other one is surprise, committed. Well, we don't believe it, but when it happens, we believe it will stay there. So in every step, when the carbon tax increases, well, we are surprised, we didn't anticipate it, but then we believe it will remain and it will not be reversed. The last one is, yes, we are surprised, but there will be a reversal. And it will be phasing out slowly again. And the point is that if policy is not credible, it will be more costly to achieve the same emission trajectory. So this is the carbon tax that you would need in these different scenarios. And in the surprise reversal, which is just slightly reversal, it's around 25% higher of a carbon tax that you would need. And correspondingly, a more negative GDP effect. So two reflections. Yes, monetary policy in emerging markets can be an effective instrument to contain inflation, especially when inflation is a demand-pull inflation. But it's a very brute force method to fight inflation from the supply side. And one of the results is that reducing bottlenecks is actually a much more efficient measure to fight supply-side inflation. And the other one is regarding expectations. So I think in that case, my argument would be this type of analysis and policy dialogue that is going on in monetary policy in the mainstream about expectation management and forward guidance, that maybe, I don't have a strong opinion about it, but there's concerns about that in the field of monetary policy, right? Because the duration of price contracts are rather short, maybe a few quarters or a year, and the cost push and demand pull are hard to disentangle. But these methods may be quite applicable to the discussion of, what are the driving forces in the choice of technique in the low carbon transition, because the expected lifetime is much longer, like around 40 years of, let's say, coal power plants. And also, we all know that Keynes had already this theory of investment being affected by also the expected profitability of the assets. And this will give us some tools to address the credibility of NDCs, because I think this is something we are, from the heterodox side, miss out on, that governments have all the NDCs, but we don't really have strong tools available to analyze the credibility of that. And I'm glad to see that there's now more and more SFC models that try to address some of these challenges in terms of capturing this forward-lookingness of behavior. Thank you.